Well, my name is Kevin O'Grady. I am a principal with a company called Concord Summit Capital. We're located here in Miami and in Denver and LA, and we're primarily financial advisors. We arrange debt and equity for real estate, and we're pretty good at it. We've done about 25 billion of it over the last 10 years. We also have a part of our platform that buys non-performing debt, and that's been in business for about 20 years. And then we have a fund side, which is private equity, which is really just my partners and I chasing yield, but we have an allocation of about 450 million out invested right now. The topic today is really real estate hard assets. And so we have a panel of people that I would like to have them all introduce themselves. And since we're limited on time, we'll really kind of comes out a little bit about what you do, a little bit more rather than your intro. But if you introduce yourselves and take about 2 minutes to tell everybody what you do, then we'll kind of launch into a couple of things that I think people might be interested in talking about, okay? Sure, please, go ahead, Ben.
Yeah, my name is Ben Lyons. I'm the founder, managing director of a small private equity fund that's currently headquartered in Raleigh, North Carolina. We were founded in Orlando, moved the headquarters to Raleigh. We are a Southeast-based private equity fund that focuses predominantly only does senior secured lending to small builders for residential housing renovation and new construction. We're an 8-year-old firm. We manage just under 200 million, so a pretty small fund. I've been doing this 38 years in this exact same space. And this is my 7th venture, so I'm excited to be here and share a little bit about what we do.
My name is Peter Powers. I'm a 2nd-generation member of MPI Family Office. We're a single-family office based in Tampa Bay, Florida. I run the real estate operations, so both the acquisitions as well as the asset management for my family. Currently, we're in affordable housing, workforce housing, senior housing, and self-storage all across the country. We partner up with best-in-class operators in those asset classes.
Good afternoon, everyone. I'm Yonel Devico with Crosby Capital. We are an asset manager investing in distressed mortgages, mostly in the single family and the multifamily space nationwide. We've been in business for the last 10 years, and we're growing the portfolio right now with institutional money. Very happy to be here.
Onic?
Hello, guys, and I'm joining from Athens, Greece. So I think I'm the furthest away at the moment. My name is Onic Palandjian. I represent Group RMC. We focus on office, purchasing assets from large institutional investors at, you could say distressed prices. We have 21 million square feet of office properties across 20 cities, mainly in the Midwest, the Southeast, and most recently, Texas and Florida.
Great, thank you very much. So we're going to kind of like pitch and catch a few topics here. One of them that I find, at least in my business, that people are constantly wondering about is the effects of COVID on our business with respect to what we do, in our individual practices. And so there's an effect on what people may think happens to multifamily, self-storage, single-family housing, for sale housing, office buildings. And one of the things I think is a timely topic is what's going to happen with office building recovery. Are we going to see a great migration of people, working from home and out of the offices? What would that then in fact do to urban office building pricing and financing and suburban? So I think the first question I would have would be out to you, Onic, is in your business, are you guys expecting to see a great deal of product come your way as a result of what's happening in COVID? Do you think that that's not going to happen? Where do you think the world's going, with regard to your deal flows?
Thanks, Kevin. That's the $1 million question. And initially, we got scared when COVID hit. We didn't know what's going to happen. 20 months later, I can tell you that our existing portfolio of 21 million square feet is performing quite well. I mean, we're collecting almost all the rent. We're collecting 99.5% of the rent from 2,500 tenants. And what I'm also going to share is counterintuitive. We're a little bit more occupied now on a portfolio basis than pre-pandemic. And the way, somebody, to understand that, you have to understand that companies are changing the layout of their offices. So yes, the hybrid model still exists. People work some days from home. And instead of one day, maybe they work 2 days or even 3 days. But the days that they're back in the office, they do need a different layout. Larger conference rooms, people not stuffed in 3x3 cubicles. So we see this as an opportunity to purchase amazing assets at distressed prices when everybody's scared about the long-term effects of working from home. But our experience from our existing portfolio is that it's a little bit exaggerated. I have to say the disclaimer is we're not on the gateway cities. So we're not in New York, we're not in LA or San Francisco. They've been hit, much, much more. But in our secondary markets, things are looking good.
So if you don't mind, guys, if you just stick with the commercial office for just a second, do you see, then Onic, you have an existing portfolio, but are you seeing an inflow, or do you have a pipeline that you think is going to be coming about of people that are going to be trading out on the debt side because the tenancy in the existing buildings is not going to be able to continue to afford the market rents that they signed up for?
That is correct. We're already seeing that, and that's why we're buying at tremendous discounts to replacement cost. That's a key metric for us.
What kind of discount to replacement cost are you seeing?
We used to be able to buy at 40 to 60% discount. Now we're buying at 70, occasionally 75% discount to replacement cost, and at 35 to 40% discount to comparable trades that have taken place in the past 4 years.
Okay, so you're buying, who's your seller?
Typically it's funds, end-of-life funds, or large organizations that need to liquidate quickly. They're acting as forced sellers, and they know that we're a reputable buyer.
Yonel, are you seeing any of this on the debt side from the debt holders on commercial office?
So right now, I would say that a lot of lenders are holding off on selling their debt. They're not very motivated on selling their debt because they get first they get some of them good collections, and the other thing is that they're just waiting to see how the market is going to turn before they start selling that. And the eviction moratorium is also preventing them to move or do anything. So they're not convinced that they're going to get the best execution on the sale of the debt.
Right. Okay, and in your guys' world, on some of this more distressed on the hard assets, are you seeing any vehicles out there that are keeping some of these out of your grasp, such as ground leasing as a way of getting liquidity and resetting the bar for some of these people for on an office building? Are you seeing any of that kind of thing happen?
For sure, some of it is that, but I mean, we're looking at 400 deals a year, and we cherry pick and we do 4 or 5. So we try to find the best possible deals that meet all our criteria, having top tenants, being at least 60 or 70, occasionally 80% occupied, in good condition because they're owned by these institutional investors. And as a consequence of us buying at the right price, our cap rates are, unbelievable. We're executing at 9, 10, and even 10.7, which was our record, 10.7 cap. It sounds like a dream.
Peter, are you seeing anything? And you're more diversified in the products that your family
Yeah.
invests in. What are you seeing in your world with regard to opportunities as a result of COVID or not, as the case may be?
Yeah, I mean, we're very, being a family office, we're very flexible. I would say two of the strategies that have come out of COVID, we were looking at before COVID, but have really emerged out of it, has been our hotel to apartment conversions. So we're buying extended stay hotels across the country. Some of them have kitchenettes already, some of them don't. I wouldn't say we're buying them all distressed. They're definitely discounted to what the comparable properties nearby are. So properties that have sold in the last 6 months have sold for. And so we're taking product like that may traditionally sell at what's called 8.5 cap rate as like a hotel, and we'll put a good chunk of money on the ones that need kitchenettes, and it's a few $1,000s a unit on some of the hotels that already have the kitchenettes, and we'll convert them to apartments. So we partner up with a group out of California that has the scale, has again the people to carry out these conversions. So they have the general contracting arm, they have the acquisition arm, they have all that. We're partnering up with them to carry out the strategy across the country. So that's one of them. The other one is we're purchasing LYNK properties across the country. We saw a real opportunity during COVID to buy LYNK properties at higher cap rates than traditional apartment buildings, but get record low interest rate, fixed rate debt. So that gave us a really nice, healthy spread. Again, can't control what we sell these assets for, but we can control what we buy them for. So when we're buying them, with a 3% or 300 basis point spread between fixed rate debt and our going in cap rate, we feel very secure. So that's what we've been focusing on right now. And that's what we'll probably focus on in the next couple of years.
On your conversions,
Yes.
For LYNK or for residential housing,
Yeah.
because you add those kitchenettes and so
Yeah.
forth, does that then qualify you for agency financing on an exit?
Yeah, so with the agency, I mean, again, once we put in the kitchenettes and all the properties we're buying already have the correct zoning. So we have the as of right zoning where just a few conditions that we need to fulfill before we can actually get the longer term certificate of occupancies, which qualifies it as multifamily. Once we get that, then again, we're focusing on growth areas. So the Denvers, the Austins, the San Antonios, the Orlandos, they're in great areas. They need affordable housing. Our rents are typically 25 to 30% below what nearby 1-bedroom, 2-bedroom apartments are, and they're 50% below in terms of our all-in rate compared to what their all-in cost is.
Are you
So
seeing any of
we can
these?
get the
Are
agency.
you seeing any of these opportunities for more affordable housing on the rental side in resort areas like ski areas or beach areas
Well, I mean, again,
lately, or has that been or is it constant? But I've seen a lot of it in our shop where people are getting into this and into the business of trying to create affordable housing in these areas, particularly because there's a lot of in-migration from California
Yeah.
and other
Yeah.
politically challenged areas or economically challenged areas. Are you seeing any of that?
Yeah, so I think it's a lot of the markets that before COVID were already experiencing a lot of growth. You talk about the Austins, the Orlandos, the Tampa Bays, the Denvers. Those markets have really they've gone crazy. A lot of people have moved from California, have moved from New York, have moved from a lot of these states that had a lot more restrictions to a lot of these other areas where there are a lot of jobs. There is a lot of stuff to do. I mean, you talk about Denver. I mean, you have the skiing, you have the mountain biking. You go to Tampa Bay. I mean, Tampa Bay is incredible right now. I'm not just saying that because I live there, but just with the sports teams and everything. So they're all coming there, and they need affordable housing. So we're able to provide rents that are, again, 20 to 30% below nearby properties in great areas, great locations, and we have great amenities. We take the common areas and we convert them to really nice gyms, really nice co-working, really nice storage. So it's a real opportunity.
Marty, you have something of 5 of something, or do you have a question?
I have a question embedded in a statement.
Okay.
So I was told yesterday by a person who runs a large wealth management firm here in Miami that rents have gone up, that houses have gone up by 50% this year, and rents are up 75 to 85%. Is the rest of Florida shadowing that? or is it trailing that, or?
Tampa Bay, from what I've seen, is leading the country. It's like Tampa then Phoenix. The single family rentals are up high 30%. And they didn't really go down much during COVID. They kind of stayed flat. Maybe went down a little bit. Apartments are, even the luxury in the workforce housing is up close to, low to mid 30%. So that's leading the country right now. So it's
Workforce
crazy.
housing's up 30%.
Even workforce housing. So there's no, how are you going to, how is the service industry going to live in these areas? So we think these conversions are going to work out. We have cities that are actually hitting us up now, telling us that we'll put money towards this cause because we've seen it already work in a lot of these other areas. And those have kind of been case studies for them.
We're financing, we're carrying on construction portfolio right now in Orlando, Palm Beach, and Miami, about $3.5 billion of to-be-built stuff. The strongest market that everybody likes is Palm Beach, because it's that most of the in-migration from the Northeast is coming into the Palm Beach area. Some of Miami is more on the luxury side, and the for sale side on the condos and the single family housing. Jacksonville is picking up a lot more of the workforce side, and Tampa is also a big recipient of this for whatever reason, and Orlando. So we're seeing its strength across all of the major markets. We're not seeing so much on the West Coast. I'm not so sure that's maybe because of availability of developable land, but anything in South Florida from Palm Beach County down, and anything over in Tampa on the west side and Jacksonville and Orlando are very, very strong right now. So I have a specific question for you.
Yes, sir.
And before I get there, I'm sorry, do you have one? Go ahead.
It's a nice question. For the debt buyer out there, are you capital structure agnostic, or are you just buying senior debt in these places?
I would say
Guy
we're
on TV or whoever.
okay.
Oh, Onic.
The guy on TV is Onic, and Yonel also trades in
Can you repeat
these.
the question so that he can hear it?
Yes, please come up and,
Yeah, sure.
because I don't want to misstate it and just save time and just ask
For the
directly.
debt buyers, are you capital structure agnostic? Meaning, do you buy best pieces? Do you just buy senior? What does the profile look like? Is it what's in the kitchen sink that you pick through, or how are you sourcing these deliver?
Well, we'll buy, on our side, on the Summit side, we'll buy pref or mezz debt.
Okay.
It would have to be in a pretty secure last dollar position for us to, usually if there's a problem on that debt, there's something wrong on the senior side as well.
Well, I mean,
So we'll try to take down the whole capital stack if we can.
usually senior curve. Yeah.
But on asset class, we're agnostic on asset class, and we'll buy corporate debt as well. I mean, only in our side and Summit, only 30% of our portfolio is real estate.
Okay.
The rest of it is corporate debt. I don't know about Yonel.
Yeah, so we're focusing on single family and multifamily, and we're buying mostly like senior mortgages because mezz, or we're concerned that the mezz or that the junior lien could be wiped out in a foreclosure. So rather be in a low LTV type of position and not buy like the mezz.
Right. Onic, are you getting to any of these assets through the debt side, or are you just buying direct?
Direct. I mean, we used to be able to find it through the debt side, but we buy direct from the seller. Yeah.
And you buy through a network, or you buy through a broker, or are you buying off market? How is your typical?
Every possible situation. Most recently, because they know us, they come directly to us. So it's off market deals. But yeah, it's a great time to be a buyer.
It's true, and to be a seller in a lot of respects as well.
Well, a lot of these organizations sell at a loss, so it's not a good time. I mean, they're forced to sell. They're selling because they have to, not because they want to. And so it's a peculiar position they're in. And for us, I mean, you're buying something at 25 cents of a dollar. Like you gentlemen said, it's difficult to go wrong when you're buying right. You make money on real estate the day that you purchase the asset because you don't know when you're going to sell and how much you're going to sell. But if you buy right, chances are you're going to make a good return.
Right. So hold on just a second. So Ben, you know, a lot of the stuff that we're trying to get around to here is like, have opportunities been created as a result of COVID, or are there natural forces that are moving assets to be more valuable because of either, call it sociological type of positions or policy positions with regard to U.S., you know, kind of economic policies, you know, different trends, you know. So in your business, you deal a lot with single family subdivision financing. So that's single family rental and sales. Are you experiencing a boost in your business because of a COVID effect, or is there something else that's affecting the demand in your business?
Yeah, I have this is 38 years in the same space. So pre-COVID, we had a lot of data. When COVID hit, we weren't sure how the builders were going to perform. We were not sure how the mortgage portfolio. So I'm a direct originator. We don't buy debt. We originate for our own good. Delinquency has dropped almost non-existent. So our builders and our real estate investors, they're not defaulting. So in my entire career, this is probably the lowest delinquency in our portfolio. The second is the duration of the loan. The average loan that we would lend to a builder to build the typical single family house, believe it or not, was around 11 and a half months, and that's dropped by a month and a half. So these builders are selling them before they're even finished, which is logical in this real estate market. So COVID has been a huge win for us.
Okay. So what do you think is driving this demand in multifamily and also in single family rentals and single family housing? What do you think?
It's supply. COVID caused people to work from home, a lot more people to work from home. They wanted to have a better workspace. And we just know that the housing supply nationally is at a historical low. You know, a stable single family housing market is a 6-month supply. In many of the cities, we have an office in Charlotte, we're seeing a 3-week average supply of housing, which is really epidemic levels, which means there's not enough housing. So on a national average, I think it's less than 2 months supply of housing, which is very low.
Can I ask one other quick question? I mean, COVID really has been more of a catalyst. I mean, we have been running behind on building single family and housing since 2008, right?
Right. Yeah.
And it just caught up all of a sudden with COVID. It caught up because everybody said, I'm moving south.
Yes.
Something like that.
So when I talk and teach about this topic, so we were building north of 2 million houses a year pre-2008. When 2008 hit, we dropped down to as little as 450, 500,000 houses a year for 3 years. Now, household formation was continuing. So it caught up to us in a big way. Now we're back up to 1.5 million average houses, new houses being built. It's still not a fast enough pace. There's a lot of articles out there that talk about that we're 5 million, 6 million houses short of demand right now.
Isn't that concentrated in certain areas too? I mean, take 5 million, you know, look at certain areas, they've experienced outsized growth. So they, you know, they're not getting, you know, they may not be getting a fair share of that 5 million.
Absolutely. And, you know, I started my career in the savings and loan crisis. So I've seen all the swings and the ups and downs. And what we'll see, and you can all hold me to this prediction, there's going to be an overbuilding. There's going to be an oversupply. Interest rates are going to rise, and housing affordability is all of a sudden going to change the landscape of the world today. You know, even with what's going on with COVID, housing affordability right now is actually better than it was 2 years ago. So it's an interesting situation.
So we can all agree, you know, overseas and here, and even all of us are experiencing a change in our business as a result of COVID. You know, there's been an increase in our business. There's definitely been an increase in our business on the advisory side. You know, the phone is ringing because people are building things, people are buying things. You know, you're seeing it in the single family, you're seeing it in your loans, you're seeing it in your side, you know, Peter, as well. So how long does this go on in everybody's opinion? Where do you think the period of time is? If we were in 2020, you know, we would have been looking at what is going to be the recovery period in the markets before we can really understand what a value of an asset is we have to understand when it's going to achieve its value that it had pre-COVID, right? Now, we're now seeing that, take shape, and it's being clarified. How long do you guys think this goes on with respect to each one of your respective specializations, in timeline? Go ahead.
Do we go first?
Yeah, please.
Well, residential housing in all of our sectors are driven by the income that comes off of the assets. I mean, that's the beauty of what we do. It's not just the value, the underlying value of the asset, but it's the underlying cash flow of the asset, which really is the protection that we have as hard asset investors. I mean, that's really the beauty of our situation, that if you look at rents historically, go back 30, 40 years of rents, they've only gone down 1 year. Okay, you guys can challenge me on this data, but rents have increased, if I'm not mistaken, every year but one. I think it was 2013 rents went down. But the beauty of what we do is it's somewhat insulated. It's not necessarily whether the prices go up or down, it's whether the cash flows go up or down. But for me, I see great times for the next couple of years because of that. Beyond that, I can't predict.
Peter?
Yes, we're very specific. We like to work, stay in the workforce housing, affordable housing. How I look at it, I don't have a crystal ball to tell you how long this will last, but I'll give you a statistic. 1 out of 5 households in the country spends over 50% of their income on rent or housing. That's a real issue.
50%.
50% of their income. So,
And that's up from probably, 13% 5 years ago?
I don't know what the number was 5 years ago, but I look at it now. It's what are we doing? Cost of construction has gone up. I mean, you can't build affordable housing. You can't build affordable apartments unless you're getting some type of subsidy. Maybe in a few different areas, but definitely not in the high growth areas. That's why we focus.
Construction of cost of goods, it's labor as well.
Right? Labor too. Labor.
So Peter, are you saying that you think we're heading for a burst in a bubble at some point, or are we filling a vacuum with emptiness that was a result of what we lost during COVID? I mean, where are we headed in your mind?
Well, what I'm
And how long?
Yeah.
May not be fair, but I want to ask.
Yeah. So what I'm getting to is I see a long runway in what we're doing. If you're focusing on affordable housing, if you can buy these products and be able to provide rents that are, a good bit below, what the traditional rents are in an area, you can provide that for people. You have a long runway. That's why we like this. There's scale in what we're doing. In terms of how long, I mean, if a lot of groups started doing the conversions or they started, getting subsidies from cities, it could be, I don't know, 10 years. It's going to take some time to really provide this affordable housing and to provide for people in the service industry that need to be, kind of close to, where their employment centers are.
So I would say about we have another 2 years before we see pricing of housing, single family stabilize. The fact that interest rate went down so much so abruptly is triggering this shortage as well. We're seeing Wall Street buying close to 20% of the housing inventory right now. This year, the institutional investors are going to buy over $100 billion of single family houses, which is for the first time more than the $100 billion of multifamily inventory that they're buying. So I read also recently a report from Goldman Sachs saying that they're seeing growth for the next 2 years in the prices of single family. So as long as interest rate stays relatively low and that the 5 million units shortage is still there, we're going to see an increase in pricing in the housing market.
No, that's really interesting. I'm heading towards something on this, but I want to get your take on it, Onic, as well, as to where you think we're kind of driving to with regard to effects of COVID and when that may stop or may not.
The future is very difficult to predict. I mean, we we thought it was over and now it's Omicron. So, this might take a while, but it's, yeah, and I don't have a crystal ball, and even the crystal balls are not telling the truth anymore. So what I'm going to say is the best thing you can do is purchase with a lot of safety. And real estate goes down in an elevator and it goes up in a long staircase. It's going to take a long time, but again, if you purchase right and you focus on the cash on cash that these assets are producing, you can be happy, especially with building materials, increasing their cost all the time, the interest rates going up, and all the other factors that I think are going to help real estate, because people are looking to invest in real assets. They cannot take more risks.
So let's think about it for a second.
About 8 minutes.
8 minutes?
Yeah.
Okay. Okay, rats. But we have a situation in major gateway cities where you have a longer recovery period, but it's more filling that vacuum. So you'll have a period of time, you'll probably experience a lot of growth there. And then we have the recipients of the markets that recover more quickly, like a Florida or a Texas or an Arizona, where it could, we're in a boom period right now. So now we've got a situation where we have, and then look, this is not a political statement. The question is, what is the effect of the current administration's economic policies on what we're all trying to do? This is another interesting question. I mean, can you spend at the levels that they're looking at spending without with a monster of inflation taking hold and slowing us all down? What do you guys think about? What do you think about introducing the politics into your business and your thoughts?
That is a very dangerous discussion, but I'll pivot to say that if interest rates rise in residential housing, the number one contributor of affordability, as my colleague here was just talking about in workforce housing, costing 50%. If interest rates rise with the price of labor and materials, the cost of what's going on with inflation, if wage inflation does not keep up, we're certainly going to see a dramatic effect. I mean, you all can play this out.
Right, why does somebody want to work building houses when they're going to make $25 working at Target an hour?
Well, there's been huge wage inflation in the labor force in building because the builders can't get enough labor to build at the speed that they're able to sell. So our clients, we lend to builders, they're able to sell a tremendous inventory. They're able to sell inventory well beyond what we're able to finance, but they can't get the labor to complete the houses fast enough. So it's a real issue, not just the supply chain, but the labor.
Yep.
Yeah, it's a loaded question. Does inflation and does something else that's moving in the winds really drive us more into rental housing and not an affordability to own? And or does it just put brakes on this growth, whether it be in the inner cities where it's just filling a void, or whether it be in the other cities that are receiving the benefits of it? I'm sorry, does somebody have a question?
Yeah, I want to make one point. I think I'm not too worried about the supply chain issue. I think it's something affordable home, right? I think I saw statistic the other day, it's like 4 million vacant trade jobs right now. And I think that number's growing. The second point I want to make, Marty sort of last year and a half, we've seen a mass migration of folks that left California or San Francisco. And I think we'll continue to see more individuals, higher net worth individuals, relocate to states like Florida and Texas, especially if you're in a political influence areas like the Trump family. Now,
Well, if you look at what we call the local real estate rags that come through on the internet and so forth, every day there's just another like Bisno there's another like 4 or 5 announcements on this $25 million condo, trade at this 30, realty of 40. I mean, it's amazing. I've never seen anything like it before.
And they're coming from California, New York.
And they are kind of California, New York.
So my sister focuses on selling these higher end residential homes. It's called between 10 to $25 million. And she'll get 30, 35 offers. And of the 35 offers, 30 of them haven't even seen the properties. They'll give them a cash offer on it. So they're like, yep, we want that property. We know where it's located. It's in a great area. There's crazy demand for the high end homes in Miami. And that's probably going towards what you were mentioning.
This gentleman had a question up in the front. Marty, maybe we could take this question as the last thing and
Yeah,
move
sure,
on.
absolutely.
Go ahead, sir.
Thanks. Hey, Onic, it's Rob Colorina here. Speaking of policy, I was just curious about whether you guys have affected anything in the op-sale world, the opportunities in the world.
Are we, I'm sorry, the specific part of that on op zones?
If you guys have affected anything.
Affected?
Yeah, if you invested in op-zone regions.
We personally are not investing as a matter of policy. We are arranging financing
Yeah, I was talking
for
about
private
right.
equity side for OpZone. I don't know if you guys have any. I mean, it's a specialization area right now, and a big part. And there's specific funds that we're seeing that invest. I don't know about the family office side, and it's in any of your business plans because of the tax benefits and so forth that are attached to it. But I don't see from the panel. I didn't see anybody in here that
We've looked at
would
it.
trade at
And
it.
again, I'm sure there's opportunities out there. It's not in the areas we want to be in. We see them in Tampa Bay. There's a few in St. Pete that are incredible areas, in which we wish we would have gotten into some of these opportunities, but now it's too late. They've already been priced crazy.
And did the infrastructure bill have any participation?
Well, out of the 2,000 pages, I don't know. But I do know there's talking about infrastructure and its effect with real estate, but I haven't seen specifically where they think it's going to fall. They're just telling us that we're going to be beneficiaries of it, but I haven't seen exactly where that's going to fall.
They kept stripping things out of it, but suppose affordable housing is supposed to get some capital, but it hasn't really been